Yellowcake is a corporate vehicle that was listed in London in 2018, and it really was set up to give investors a means of investing in the uranium commodity without all the other activities related to mining, geology, project risk, processing risk. Uranium is not a commodity that you or I could easily invest in. It's very, very regulated. You can only store the commodity in 3 places in the West. There's one in France, one in Canada, and one in the US. You need to go through a huge bunch of regulation and open up accounts. The storage is not cheap. So we created this entity that holds physical uranium, and so investors can play the uranium price through our share price. If you look at our balance sheet, we own 22 million pounds of uranium, more or less, and we've got $30 million of cash. When we IPO'd in 2018, we raised $200 million. We bought 8 million pounds of uranium at $21 a pound. Today, the uranium price is $106 a pound, and we've got 22 million pounds. And our in cost is in the low 30s. So, it's a capital appreciation vehicle, and the commodity price has done, in a sense, what we'd hoped it would do, and more than hope. We did a lot of fundamental analysis on supply and demand, and we think that the uranium price still has a way to go, because supply is going to lag demand.
Trident is a metals and mining royalty company. We're listed on the AIM market of the London Stock Exchange. We invest in all commodities excluding coal, all metals and mining commodities excluding coal. And to that end, in our portfolio today, we have gold, silver, lithium, copper, zinc, mineral sands, and iron ore. And we're looking to continue to build up on that. We are very much growth oriented. In the last year, we've acquired 4 royalties over, again, gold, silver, copper, and zinc, which is quite exciting, all without using our cash balance, so no incremental shares were issued for those transactions. And we've also recently refinanced a less flexible term loan with a very flexible revolving credit facility with BMO and CIBC, which should facilitate that growth going forward. And what's nice with the royalty model is that you have quite a lot of asset diversification. So where one mining company of our size might have 1, maybe 2 mines, we have quite a few assets. So we have 21 assets, of which 13 are cash flowing.
At the moment, we're developing 2 rare earth projects, one in Palabora in South Africa, our flagship project, and one in Brazil called Uberaba with Mosaic, the big multinational fertilizer business listed in New York. So it's been a very, very good year for Rainbow. Last year we attracted a $50 million commitment from the US government via the DFC into the project at Palabora as development equity. And that shows a lot of confidence by the US government in Rainbow, as they've done their own DD on us and on our process. We've also announced that we've started our 2 pilot plants, the front end at Mintek in South Africa, where we're producing a cerium depleted mixed rare earth carbonate. This mixed rare earth carbonate has been derived from phosphogypsum at Palabora, which is the rare earths sit in the phosphogypsum, and we are extracting the rare earths out of this phosphogypsum and producing a mixed rare earth carbonate, as I mentioned. We're then shipping that carbonate to a facility in Florida, in Lakeland, where they're doing the final downstream separation, which is to produce separated rare earth oxides. And we've got the 4 key permanent magnet rare earths known as neodymium, praseodymium, terbium, and dysprosium. So we are busy with that in Florida, as I've mentioned. We made an announcement this morning. Our initial separation has been very, very positive using the K-Tech technology, which is an IP developed by the American company called K-Tech. And as I've mentioned, our first separation results have been very positive, and we'll end up doing 3 stages of separation to get to our final purity level, which is 99.5% purity of separated oxides, which then feeds a metal business, a metal and business that turns into alloy, and that alloy then gets fed to the permanent magnet manufacturers. There's still a couple of chains in the strategic supply chain for rare earths that have to take place after we produce separated rare earth oxides.
Metals Exploration is a gold miner listed on the AIM exchange, and our operations are in the Philippines. Last year we produced 85,000 ounces of gold with a net free cash of 73 million. The company started badly. I took over in 2019 and we basically restructured the business, got the business up and running, and now we've got a very profitable little mine that is doing very well. I think the reason why I see our share price is undervalued is we are looking at a company that's always been highly leveraged with debt. It used to have a bad history. We've turned that history around. The debt will be paid off by April, and our future is in some new prospects in the Philippines. We've done a little bit of work over those prospects. One looks to be a significant copper find at surface, between 1 and 16% copper across multiple areas. It's about 8 square kilometres of copper at surface. And the other is epithermal gold, so with narrow vein but highly prospective gold opportunities in that same region. So looking at the future, we have a bright future with a lot of cash in hand, and we look forward to growing the company.
Empire is London listed, we're on the AIM, but we are 100% Australian focused. It's a company with a pretty decent portfolio. We started with, well, we're working with about 4 different exploration camps, over 2,000 square kilometres. The most interesting of which is this Pitfield project, and that's the one that's taking up all of our time and attention now. That's where we made a maiden discovery back in April last year. A massive titanium mineral system that we're looking to bring into development. The next step for us is to really understand what we found. We've been working on this for less than 12 months. We drilled the maiden drill holes, 21 holes in April, May last year. All 21 holes hit this fantastic mineralisation. We went back in with diamond drilling late last year, did 3 big diamond drill holes, 400 metres down. Every hole, from surface to the end of the hole, every metre, high-grade titanium. So we suddenly realised the scale of this. We saw some really good grades coming to surface. Our latest drill program, just completed before Christmas, was 6,000 metres, 40 holes, near surface high-grade sandstones that were full of titanium. Again, 40 holes, every hole from surface to the end of the hole in high grade. It's just an amazing geological anomaly. So next, work on the processing, work on the minerals, and work on working out what the value of this titanium deposit really is.
Atlantic Lithium is developing the Ewoyaa Lithium project in Ghana. This is a near-term project with low-cost characteristics. The project has an overall size of 35 million tonnes today at 1.25 lithium content. We believe there's significant possibility to increase that size over time, but the real characteristics of the project are that it's a very straightforward project. So relatively low capex, and for the mining industry, 185 million capex is not a big number. We are looking to complete the permitting of the project this year, having last year achieved some very significant steps. First of all, we agreed with the government the mining lease, which we did at the end of October. We also agreed a significant investment by the Sovereign Wealth Fund of Ghana, MIF, with them making their first investment now at the Atlantic Lithium level. And what we'll see by mid-year, I hope, is an investment of nearly 28 million into the project itself. So it's an important project for Ghana, and it's an important project for shareholders. In the current lithium environment, this project sits very well on the cost curve. So it's very important to be able to produce at relatively low cost. So all-in sustaining costs are stated at $675, and the C1 cash costs are around $370. Those are very strong numbers in the industry today.